In today's video, I want to talk about a common practice in retirement planning and investing that can end up costing your retirement big time. Let's get into it. The topic of today's video is the ever common practice of using risk tolerance to determine your investment allocation. On the surface, this approach makes sense. The best plan, whether it be financial or a diet plan, is the plan that you can stick to. And this is the general allure of using risk tolerance in portfolio decisions. Most of us know that the stock market has outperformed arguably better than every other asset class over the long term, but has done so with a fair amount of volatility. It's easy to look at the upside of a stock portfolio and go, I should just invest in that. But those large returns are only earned in the long term, and it's too easy for investors to panic and give away all of that upside during periods of volatility. Take the graph on the screen. Say you were mostly stocks and had roughly $2 million going into 2020. The first 3 months of investing were pretty calm, and then bam, COVID becomes an international pandemic, and within days you lose $300,000. An easy scenario for really anyone to panic in. Say you go to cash here and don't get back into the market until things have calmed down during the fall of 2020. The impact of poor timing and too aggressive investing cost you approximately $600,000 in ultimate value. I don't have it on the screen as an alternate data point, but if you would have just invested in a more balanced 60-40 portfolio and stayed invested throughout that period of time, your money would have turned into $2.5 million. Again, the best plan is the one that you can stick to. So risk tolerance investing aims to gauge whether you will panic and bail on a plan ahead of time, and aims to keep you in a portfolio that you can ultimately stick with. This makes sense and seems like a smart approach. So why shouldn't you use it in your decision making? Reason number one, most risk tolerance questions and questionnaires are worse than useless. They do a terrible job at actually trying to assess risk, but to be fair, assessing actual risk tolerance is nearly impossible, as we will discuss. I would offer it's worse to inaccurately measure risk tolerance than never assess it in the first place. Let me give you some examples of some risk tolerance questions I've seen advisors use. First, what is your current age? If I may, what does age have to do with risk tolerance? Now, I think this question is being used as a sort of proxy for trying to measure how close someone might be to retirement. And then obviously if someone is close to retirement, they may want to invest in more safety, but this is kind of a one-size-fits-all approach, and that's part of the problem. You could have a 60-year-old planning to work another decade, and you could have a 40-year-old that just retired. Here's another set of questions that you rank from 1 to 5 based on agreeableness. The problem I have with these questions is the ambiguity here. Take the first question. What does above average risk mean? What does above average return mean? Now, if I polled the audience watching this video, I would probably get different answers for both of those questions. Without having clear definitions, you are going to get vastly different interpretations of both questions as well as results. Now, I could nitpick each and every question here, but let's move down to number 4. Does how informed you are as an investor make you a more aggressive or a more risk-averse investor? What do you need to know to be considered informed versus non-informed? Also, questions not specific to your situation or not deep enough are another area these assessments can go awry. What would you do if your portfolio fell 25%? That's it. Portfolio decisions aren't made in a box. There's so much context around a decision that matters. When your portfolio drops 25%, it doesn't just drop. There is usually some big catalyst in the market. It's the news and the what ifs around that catalyst that really make it scary. For instance, there was talk during COVID that we were entering a modern day Great Depression. It wasn't just the fear of the drop, but also the fear of what's next. Without being in the state of mind that the investor will find themselves in when they face a 25% drop, it ends up being an impossible question to accurately answer. Now, the unfortunate reality here is that most risk tolerance questionnaires are not actually built for your benefit, but rather liability protection for advisors or custodians. If the problem ever arises, many will look for something to point to and say, look, I was doing exactly what I was supposed to do. They answered the questions, not me. Another big issue with risk tolerance questionnaires is the fact that risk tolerance changes over time. Take a big life event like retirement. You might have been the most stoic accumulation investor, not caring or even paying attention to the ups and downs in the market. But many find it very difficult to carry this view into retirement. After all, in retirement, this is essentially all you have left. When working, you could stay working, and sure, you might have to move back retirement or certain financial goals, but you are fine. When you lose money in retirement, it feels differently. Stress is typically the highest during the few months and years before retirement and directly after. Now you'll start to view losses not as a percentage of your portfolio, but rather as years of lost income. Again, it hurts differently. We lightly touched on this already, but a big problem with risk assessment is often you are answering questions during a more stable time in the market. When zooming out on a long enough time horizon, decisions seem simple and all of the emotion is taken out of the process. This is at odds with the whole point of the risk tolerance process because all bad financial decisions are emotional ones. For instance, here is a 200-year chart showing stock market performance here in the US. Now, gosh, you zoom out long enough and stocks just seem to steadily rise each and every year. Of course, you can handle a little risk here and there to achieve that kind of growth. Well, on this chart here is the Great Depression and the lost decade of the early 2000s. They seem like blips, nothing burgers when zoomed out. But that's not how we live risk. That's not how risk feels. Risk tolerance questionnaires can't encapsulate the true feelings of risk. It's not just, oh, your portfolio has dropped a few percentage points, what would you do? In 2008, this is how it felt. Your portfolio is down nearly 50% the second time in the last decade. In fact, investing for the last decade meant your portfolio's effectively gone nowhere. All that time and energy amounting to nothing. And the reason your portfolio basically cut in half again was because we're in the midst of a global financial crisis where banks are failing left and right. Historic organizations that have been around for decades are filing for bankruptcy. Unemployment is at a multi-decade high. And you know quite a few people personally who have been laid off. Every day, the news shows the latest scary stat of the day and so on. This describes risk in your portfolio a lot more accurately, but still fails to put you in the exact state of mind that you would be in given that situation. And this fear changes your tolerance. It's as if risk tolerance is a constantly moving goalpost that should certainly not be controlling your investment decisions. Practical issue number 3, rarely do I meet spouses who have the same risk tolerance. So in that situation, who wins? The person who is most interested in money in the financial plan is the quarterback of the plan? Should you just split the difference? And if one person is more aggressive and the other is really conservative, you just end up in the middle where maybe both people are unhappy? What about just invest each person's account the way they would want? In my opinion, none of these answers are acceptable, but we'll talk about a better solution here in a second. Number 4, we talked about how risk tolerance can change due to life events, but it can also change and be affected through coaching and education. The thing that frustrates me about risk tolerance is that it's treated as if it's an innate part of us, like height. You were just born that way as a conservative or aggressive investor. I wouldn't say that risk tolerance increases or decreases through education, but understanding what's going on in the history of markets just overall makes you a better investor and allows you to handle normal portfolio activity that you would have previously deemed extraordinary portfolio activity. To someone unfamiliar with the stock market, they might see big swings in either direction and think, gosh, the stock market is basically just a casino. They might interpret some big negative news event as a predictor of things to come and think, holy crap, I need to go to cash regardless of whether I have 100%, 50%, or just 25% in stocks. But through coaching, teaching a bit about market history, how the stock market works, showing long-run stats of stocks over time and getting them very comfortable with what to expect, a seemingly conservative or risk-averse investor can have a complete reframing. This can ultimately make you a better investor that can handle more risk and ultimately, for the most part, be rewarded with more return over time. Here's another related example. As of recently, I've noticed a lot more negativity towards investing in bonds, which is odd because for the first part of my career, retirees generally loved bonds. So what gives, what's changed? Well, for those that don't know how bonds work, bond prices move inversely to interest rates. Since the 1980s, interest rates have essentially been steadily falling decade by decade, making bonds look uber attractive from a risk-return standpoint. Then in 2021, as interest rates started to rise, bond prices fell. For the first time in decades, aggregate bond funds were down 15 to 20% plus. Now, for some retirees, this might be incredibly perplexing. Bonds offer lower returns, but they're supposed to be safe, not down 20%. You can look at a number of videos on our channel from before this interest rate hike that warned retirees about potential risks in bonds and what it meant for safe investing. But after the short bond bear market we saw, I found a lot of retirees throw bonds out of their portfolio and start to prioritize just holding cash. What many don't realize is bond prices ultimately revert back to something called par. This means that if a bond falls because of interest rates rising, yes, a bond will lose, but generally only in the interim. If there are no defaults and no other interest rate changes, that bond price will slowly climb back out of that drawdown and you will end up in the exact same spot by maturity. It's really just the path to that ending point that changed. So I found a lot of investors making big changes due to perceived risk, effectively locking in bond losses by not understanding what they owned. Again, this comes back to the point of education and coaching, making you a better investor and thus generally increasing your tolerance. So rather than beginning at a point of investor risk tolerance, I think it's far more important to recommend a portfolio based on the retiree's situation and needs, even if it's disjointed from their tolerance. Then coach and educate as to why that portfolio is best for their situation. Educate on what to expect from investing this way, coach through emotion, and make sure that investor can stick to that plan. And this leads us to number 5. If not risk tolerance, how should you invest? Well, here at Safeguard, we believe you should invest based on your goals, otherwise known as risk capacity. Let's take a smaller example of what I mean here. Say you just retired, and as part of your plan, you're going to sell your house and RV around the country for 18 months. Then buy a home in another part of the country for roughly $500,000 thereafter. Now, I don't care how risk-loving you are. It would be crazy to throw that $500,000 in the stock market and hope you make out well on the other side. You have a little better than a 60% chance that you will have more money in 18 months than you do now with that bet. From a risk capacity standpoint, it would be irresponsible to invest that money as if you have a multi-year time horizon because you only have 18 months. The withdrawal need you have controls the investment allocation, not risk tolerance. Well, you can simply scale this concept up through the rest of your portfolio. Here at Safeguard, we call this a liquidity plan. Others might call it liability matching. The concept is this: in retirement, you will need money out of your portfolio at various times. Well, rather than just setting some arbitrary allocation based on this idea of risk tolerance, you allocate based on what your plan says you need. Have big withdrawals coming in the short term? Well, it's prudent to have a good portion of those withdrawals coming from safer investments. Knowing when you need the money can help you invest in bonds more safely, as interest rate risk is eliminated if you hold those bonds to maturity through things like bond ladders. Let's say through this process you set safety aside for 6 years worth of withdrawals. Well, this can help greatly increase risk tolerance because you have a 6-year buffer between you and the most volatile portions of your portfolio. Effectively, you separate your portfolio into safety and growth. The more distance you have from volatility in the growth portfolio, the easier it will be to stay a long-term investor. So we accomplish the same goal of making sure you can stick to the plan, but do so in a much more objective and logical way. Your risk tolerance can change greatly based on day-to-day emotional fluctuations. It's unlikely your income need changes greatly based on those same emotional fluctuations. If income need changes for some unforeseen reason, well, then we have an objective reason to make an adjustment versus, again, making those changes based on emotion. And so if you're someone who's been making investing decisions based on some notion or idea of risk tolerance, hopefully this video gave you pause and offered an alternative path. A recent paper by 2 highly respected PhDs noted the performance and income benefit of using strategies like liability matching, amongst others, to improve retirement outcomes. We talk about this paper and 2 others in this video right here. Click here to learn more, and always remember, you don't need more money, you need a better plan. We look forward to seeing you in the next video.